What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
Welcome back to another episode of the Long Game Podcast. You're here with me, Thomas Kopelman, and my co-host Jacob Turner, and we have Dave Haughton again here for part 2. So if you didn't listen to last week, you need to. Last week was really all about kind of the basics of estate planning for business owners, but I think in reality, as I look back on that episode, it really is estate planning 101 for everybody, difference between a will and a revocable trust, why revocable trusts do make sense for the vast majority of people that, especially Jacob and I, work with. We talked about, real estate and some asset protection type things. But this episode is going to be kind of almost a case study for some of the clients that Jacob and I work with. So, both of us really do specialize. I mean, Jacob has athletes, also business owners, but we really do specialize in helping business owners scale and sell. And when you do that, taxes are the number one thing to look at, is obviously the way that we add the most value. And there's income tax planning, there's capital gains tax planning, and then there's estate tax planning. And the combination of those three is how people in this area, take home ones to tens of millions of dollars more. So the case we're kind of thinking of here is business owner. He owns 75% still. He's carved out 25% for other employees, etc. The business is going to be selling in the next few years for about $100 million. So this person is expected to take home about $75 million. And I'm sure there's people here like, oh my gosh, that's crazy. But I think you'd be surprised how many people that you don't know are kind of in the background running businesses that have these coming about. I mean, I think I've probably met with 25 people this year that this is going to be what their next few years look like. And I think the reason why we also picked a larger number is it becomes really hard to think about estate tax planning if you're younger and you're nowhere near the exemption. There still is a lot of value to getting money out of your estate and letting all of it grow out of your estate for a really long period of time. But if we know the exemption's 27, over 27 million and you're 15 million net worth, it's really hard to say, well, let's go carve out and even use one of all of our exemptions, or, even when it sunsets, all of one of the spouses. So that's why we went with such a large number. And we're going to talk about some of the best strategies to use. And so, Dave, I'm going to hand off to you. When you think of this situation, what's probably the first structure that comes to mind and why?
Well, I think, the first thing that jumps out at me when someone's going to be going through a business sale is what's going to be the capital gains tax liability. Because, what's the basis in that business? And, thinking about what you want to do with that business prior to sale. And, one of these estate tax, or actually estate planning tools, a trust that could be used in connection with a business sale is a charitable remainder trust. And basically, just very basically, what a charitable remainder trust does is it gives a person the ability to stretch out a capital gain over a period of years or potentially over their lifetime. And so it can be a really powerful tool for income tax planning. And a lot of people see, charitable remainder trust, it's got the word charity in it, we're giving it away. Not necessarily to a large extent. I think that people need to have some level of, philanthropic tendencies to do a charitable remainder trust. But, if you're selling a business for $100 million and a lot of that, if not most of it, is capital gains, you're going to realize that all in one shot. You might want to stretch it out over a long period of time. And then at the end of that period, whether it be death or it be the end of a term, the remaining assets are going to go to charity. That only needs to be 10% of the initial value, essentially. So as you calculate it out, 10% of the initial value needs to end up with a charity. In the meantime, you or your family members can receive those annuity payments with the tax liability stretched out. So that can be a really powerful tool. You don't have to put the whole business in there, obviously, but to mitigate some of that tax liability, that's the first tool I think that would come to mind. Aside from the estate tax, the income taxes.
Yeah, I think pausing there is important because I think this is a really good structure. And it's actually one we find very often in kind of this like medium net worth range. Like people who are like, okay, I want tax planning, but I also don't want to give all of these dollars away to charity. So getting that annuity back per year can actually have a lot of benefit if you're like, okay, well, I'm going to be 5 million net worth after this sale. Like, is that enough to live out my life? Great. It's probably not. So I need some income coming in. I don't want to just donate it all away and say, bye-bye to those funds. It also is a good tool the farther you go up the wealth range, but obviously the annuity side of things is slightly less important the more income and wealth that you have.
Right. Yeah. And I mean, you also got to look at, what your income tax rate is. If you're paying 20%, no matter what, you might be taking the hit and not need all the complexity of it, but it's important just to know that is out there, to model it out, because if you get too far down the line with the sale and you have a binding agreement in place to sell the business, you're probably no longer going to have the charitable remainder trust as an option to contribute it before the sale. So it's just an important thing just to flesh out.
Yeah, I think maybe that was sort of what we should have started with. If you have your LOI in place, that's kind of like you're out of tax planning pre-sale. It can come post-sale, but you have to do everything pre-LOI. I've had multiple people reach out to me. They're like, I have an LOI in hand. This sale should be completed in the next couple months. What should we do? And it's like, you missed it. And they're like, well, what is it? LOI that's signed, approved? Is it handed to me? Like, when does that come into play? And it's like, if that's there, you are past the time of being able to think through and get these structures in place.
Right. Absolutely.
Okay. So that's the first one. What comes to mind next?
I think family limited partnership. I mean, it's going to depend on all of this, depends on how much time we have, before the sale. So,
Let's assume a couple of years.
Yeah. Yeah. So if you've got a couple of years or a few years, family limited partnership, what that is that's a structure in which you can get assets out of your estate. And typically you can do it at a discount while retaining control. And so basically the way that works is if you form a family limited partnership, there's a general partner and then there's limited partners. The general partner is the one who makes all the decisions, and the limited partners don't really have a lot of decision-making powers, but they have equity and they have rights to distributions. And so what you can do with your family is you can set up a structure where there's this family limited partnership. Maybe you name the general partner as 1% and you stay in power. And then the limited partners, you carve off some of the business to transfer portions of the business to maybe the kids as limited partners. And what happens in that case is, since the limited partners don't have a lot of control and they can't make a lot of decisions regarding the business, you're actually able to take a discount on the gift of those interests to the family limited partnership, which can be, it's you'd like to be conservative with it because you're kind of testing the IRS to audit you when you take these discounts. So you don't want to get too aggressive with it, but some people will take 30% discount. So, you make a $10 million gift. Normally you'd use up $10 million worth of your exemption. Well, you only have to use up $7 million worth of your exemption. That can be a really powerful tool.
Yeah, I always see the number there between 20 to 30% is like, I've never heard an attorney say over 30, and I've never heard them say really under 20, but I typically most commonly hear them say like 25 to 30, which is obviously, that makes this a really powerful tool. Like anytime that you can have discounts and get more out in your name, it's the same idea of like somebody comes in and they have $40 million of their net worth. And it's like, whether it's the market down and, we won't talk about step up in cost basis and things like that. There a lot of times are good opportunities whenever there's discounts to do tax planning. It could be the same thing with Roth conversions, right? The market's down, you can convert more over to Roth using, having more fill up those brackets.
Absolutely.
Okay. So I think that's a good second one. I don't know how deep we can go into that one because it gets really complex, right? Very rarely is somebody thinking about estate planning and that's the only tool they use. But when you have a business, and a lot of times if you want to pass it on to kids, it's a really good, it's probably the first tool.
Well, I think what's interesting, Dave, about like the two that you just mentioned is if you go back to the thought on either one of them, right? The charitable remainder trust, it does have this charitable component to it. There's some planning around it. You're getting this annuity back. The family limited partnership, it's really meant for a family, right? Like I'm gifting money to the next generation in a discounted fashion. I think this always goes back to the planning. And this is why it's so important to make sure you're doing this on the upfront, not just from the standpoint of getting these documents in place, but giving yourself really time to think through. Like typically when you get an LOI for $100 million business, and to Thomas's point, I think people listening would be surprised how many boring businesses are out there that are worth this kind of money. But that's typically taken 5, 10, 15, 20, 25 years for somebody to build, sometimes even longer, sometimes multi-generationals, right? You want to make sure you give yourself proper time to think about, how do I want this money used? How do I want this structure used? Because we can talk about all the tax advantages, but at the end of the day, it needs to make sure that the plan is aligned with what you actually want to happen. And if your plan was like, I don't want any complexity and I'm just going to pay the taxes and move on, I'm going to tell you right now, that's not the worst thing in the world. Okay.
Yeah. And, two things spring to mind with that. One, and this is where the advisor is super important, the complexity of these tools require a lot of administration during the period, right? So charitable remainder trust, you need to make sure you keep up with the tax returns, you follow the annuity schedule, everything is done right. Family limited partnership, you're dealing with multiple entities, multiple accounts where the money needs to flow through. I once had a client that we did a family limited partnership for, who owned a lot of rental properties. And it was a great plan, was going to save a lot of taxes. It was in Massachusetts, so there's going to be a lot of Massachusetts state tax savings too. Put the plan in place, gave the instructions of what needed to happen. Comes in a year later, was just depositing the business income directly into his personal account, not flowing it through the FLP. And it just makes the plan all smoke and mirrors. The IRS looks at it, it's not worth the paper it's written on. And so, that's another thing that comes up, is the client motivated to actually follow through? Are they sophisticated enough? I think if we had the client's financial advisor involved with that plan, I think they probably would have been, like, slow your roll. I don't think that this is something you're actually capable of keeping up with. Why don't we try something a little more simple?
Yeah. Really, really good point. Honestly, sometimes horror stories are the best way for people to learn. And kind of going back to what Jacob was talking about here, our process when we go through this is, we meet with people, we kind of hear their goals, we're thinking about the planning, we start to introduce ideas like, oh, have you thought about SLATs? Have you thought about, multiple of these things that we talk about? Educate them a little bit. The next meeting, now that we know them better, we're going to present ideas to them. So all of the ones we talked about, plus some, some new ones, like here's kind of the idea around why does that make sense? Then we typically do one more meeting where we narrow this down a little bit. And then we bring in an estate planning attorney where we update them on what's going on. Here's who they are. Here's how they think about estate taxes and charity and all these things. Here's tools that we've totally got out that don't make sense for you. So by the time they sit down with an attorney, this is their fourth time hearing these strategies. And I think the reason why bringing this up is important is half the time you talk to somebody about an investment opportunity or a Roth conversion or whatever, it takes time, right? It takes a little bit of time to understand what it is and why it is. This is that times 10. This is things that 99 out of 100 advisors have never heard about. They've never put in practice. They've never done. The average person, business owner, is going to be farther in left field than that. And so when you're thinking about when do I bring on the team to do this planning, it's not when it's anytime close. Like it is years and years early, because you don't want to rush into complex decisions because it's never going to be good. It's kind of how I think of 1031 exchanges, right? They can be good if you plan, but if all of a sudden you have a short window and you have to make a purchasing decision, most times you're going to end up making the wrong decision and one that you regret. No matter how good your team is, nobody wants short timelines. All of these take a while to put in practice.
Yeah,
everybody agrees. That's perfect.
Absolutely.
Okay. So strategy number 2, let's go to another one.
Yeah, so I think the other one that would spring to mind is, and you had just mentioned it, SLAT, spousal lifetime access trust.
Is that the first one that typically comes up for you? Because in all of our conversations, it's always like, oh, I don't know about moving things out of my name. SLATs, right? Like SLATs are kind of like that easy one where it's pretty easy to get people on board of why that makes sense.
Yeah, I think it's the best of both worlds, right? You can get assets out of the estate while, a lot of times when people think about that, You make even with a family limited partnership, you are making some irrevocable decisions that you're not going to be able to take back necessarily in a lot of circumstances, and you're giving up control to some extent. The level of control is going to depend on the instrument. But with the spousal lifetime access trust, you're able to put assets into the trust. They're a completed gift outside of your estate, but you can still have the spouse as the beneficiary during the trust term, and while the spouse is still alive, and even sometimes you can have the spouse as the trustee. So that's a lot of flexibility. You want to be really careful when you're forming a SLAT, because you got to make sure that and when we're talking about a business, presumably the person who's putting the interest into the SLAT is the owner, obviously, because when you do a SLAT, it has to be your assets that you're putting in. You're not putting in joint assets. It has to be one of the spouse's assets that you're putting in. Otherwise, it can risk the plan. There's some obvious risks to spousal lifetime access trust, because we talk about that you're not giving up control because it's still within the spousal unit, but things happen. So what if you get divorced? What if the spouse passes away shortly thereafter? So you got to take those risks into account. But of the irrevocable structures to get assets out of the estate, it's one of the more palatable ones.
Yeah. And it's honestly, I mean, again, it's one of the ones we always talk about first, because people just get behind like, oh, at least I still can use it if I need it. The things that people have to be aware of, right, is if you're going to use both spouses, which this situation, this wealth range, most people would. And so a lot of times it's different states, different assets are like the two main ones. And a lot of times people advise different years of setting them up, because basically if they're seen to be the exact same thing to benefit each other, then they're basically going to get disallowed. The one question I have for you, as we think about SLATs, and I think we're like, okay, we can use it, but what's the downside of using it? Like, what do you lose if you use it? Because again, this is moving money out of your name, out of your estate for estate tax purposes. The goal is not to use it.
Right. Yeah. And I think that's a really, really important point, is that you're getting the assets out of the estate and you want them to grow out of the estate, because eventually they're going to get passed on to the next generation, either free of tax, or you're mitigating the total estate tax bill by a lot. So a lot of times these questions about, will I have access to it? You don't necessarily, in a perfect world, you don't want to ever need it, because the spouse takes money out of that SLAT, it's coming right back into the estate. So, it's really something to think about, is if you're going to form a SLAT and you say, oh, well, but I might need this money, it's probably not the best approach, because you're going to spend a lot of money on a complex plan and you're going to get the assets right back into your estate. So it's good as like a valve that's available there, and it can give you some comfort, but it's still an irrevocable vehicle, and the person who's putting the assets in is still giving up total control to someone else. That someone else just happens to be ideally someone that you trust forever.
Yeah, this is an important point. People need to understand, especially with SLATs, that this is not the time to not have the hard conversations. And whether you want to have that hard conversations with your advisor or your estate planning attorney, you need to be really honest with each other around like, what does my relationship with my spouse look like? Because Dave, to your point, like, you are giving away this money, right? Like, if you give away this money and something happens to that marriage, like, you gave away the money. That money is most likely not going to benefit you in the future unless your ex decides that they want it to, right? So you really need to understand, like, what is your dynamic look like? What does your relationship look like? And I just encourage everybody, don't be afraid to have the hard conversations. Like, this is the time that you want to be having these conversations, especially when we're talking about irrevocable gifts, where you're making something that, this is not like revocable trust like we talked about last week. You're making something that like we really can't go back on. Okay. So you need to make sure that you're sure about it.
And the way that I think about this is kind of similar to like how you can actually, you can take money out of your Roth IRA. You can take your contributions out of your Roth IRA if you need them, like backup emergency fund, sure, but it's not efficient and it's not the goal, right? Like, I think it's helpful for people to know, because a lot of times you're like, well, what if this happens? And what if this happens? What if this happens? Like, well, this is what would happen, so you would be fine. Like, if you're at the point where you need the money from your SLAT, you're probably not thinking about estate taxes anymore. You're thinking about living out your life the way that you want to. So, but you still did use the exemption, which would kind of suck.
Right. Yeah. There's always ways to unwind trusts if you really need to later on. They're not always wonderful ways, but I think, it's such a good point about, you can't go back and say, oh, no, that's really mine. Because what are you going to say to the judge? You're going to say, oh, no, I was just doing that to avoid taxes, but really that should be mine. They're going to say, no. So
we don't care about your taxes.
Right.
Okay, cool. I think we hit on that one. What is another one to think about?
I think another thing to think about is when you're talking about, a level of wealth at ultra high net worth that's going to be passed on for generations, you don't just want to be thinking about, all right, I want to mitigate my estate tax bill so that I can pass it on to my kids. Well, what's going to happen now when the kids get it? Especially it's going to depend on how many kids you have, but, and how much it's divided up. But now they're going to be adding on to their assets. They're probably going to be receiving the assets in their high income earning years. They're building their own estate. Do you want to find ways to not have it pass through their estate as well? And so that's why something like a dynasty trust, a generation skipping trust can be really important so that you can pass assets from your generation to the next generation so that the children will have access to those assets where they can really use it. They can get distributions from it, but not in such a way that it's going to go on top of their estate. So then when they pass away, they have their own estate tax problem. You can essentially do estate tax planning for the next generation now by making sure that the assets don't automatically pass through their estate when you pass away or when they pass away.
And you've written a lot about this too, and the importance of it. And, we were talking about this before, I'm working on a client situation, partnering with another firm of like mom and kid. And this is a very big thing because mom's about 30 million net worth. Child is, in his mid to late 30s, and he's mid 20 million net worth as well. And so it's like, okay, when you really get to this wealth level, estate tax planning is like not a lifetime thing. It's a, generational thing, right? It's the same thing we talk about tax planning, right? Tax planning is not a this year thing. It's your lifetime thing. And so the way that you pass on assets is really, really important, but also thinking about, hey, if your child already has estate tax issues, like they're probably not the right ones to do it. And they probably are going to be okay with, we don't need it. So do the other siblings potentially not have much wealth? Is it better off to give it to them and then skip to grandkids? But if you think about it, the child, if they're in their 30s and they're over the limit, the kids are getting a lot of that too. So they're already, they're going to be over the limit. And at the end of the day, you're going to pay estate taxes, right? I mean, I don't think the goal is to pay zero estate taxes, but the goal is to pay as close to zero as you possibly can, far from what you would do if you didn't do any planning.
Yeah, absolutely. Yeah. I think, obviously if you can come up with a plan to pay zero estate taxes, that's ideal. And right now, with sunset coming, you can do so many things to mitigate that later bill because we don't know where that estate tax is going. But, so long, you just have to be aware that these tools are around. You don't necessarily have to use them, but just get educated and then you can make a decision. You might, like you're saying, I once had a client who they said that they wanted to use an irrevocable trust to get their rental property out of their estate for Massachusetts estate tax purposes. And I told them, actually, your child's going to lose a step up in basis if you do that, because if they sell the property, it's already been gifted out of the estate. There's going to be a huge capital gain because there's like zero basis on this property. And the capital gains are actually going to be worse than the Massachusetts estate tax liability. And they said, well, I don't care. I don't want him to sell it. I think he'd be an idiot to sell it. So I want to do it. I want to make it hurt if he has to sell it, which was an incredible perspective to take, right? I don't know if I agree, but clients are all different and they all have different goals in mind and have different control issues, different family dynamics. So they really just need the information to know how they can do the estate tax planning. They have to know that the more planning they do, the less control they have. The less planning they do, the more control they have, but probably more taxes.
Totally. Yeah, I think it's important too, with each level that we do, if we use the analogy of we're building a house and we have our revocable trust as our foundation, and then maybe we have some more advanced estate planning on top of that. which each one of those aspects, if you think about it, like as you're building a bigger house, if you built a really big house, there's a lot of other things that come into play. Like you might want to hire a housekeeper, and you might want somebody to take care of the landscaping. You might have a pool to take care of, and all this stuff starts coming into play. And I think that's how I think about this estate planning process, because what I see so many times, Dave, is people think about estate planning just as the documents, but they don't think about the planning around it, right? You mentioned this idea that, hey, if we gift this into this irrevocable trust, we're not going to get up at step of a basis. That's a huge planning opportunity, because if you have this irrevocable trust, what assets should I put in there if I'm not going to get a step of a basis? Like, these are things that you need to be thinking about. Another really common misconception I see is, like, with life insurance, people often say, well, my net worth, it's not above $13.6 million, estate planning exemption. Well, life insurance feeds into that. And some folks have huge life insurance policies, whether it's a buy-sell agreement in a business or something else, that really starts to come into play. And they're not even thinking about that. And that's where I just think, if you think about it like a house, we're building all these levels, there's also additional planning that comes into that as you're starting to build that house. It's not just the document creation.
Absolutely. Yeah. Yeah. Estate plan, yeah, is a confluence of everything. You got to look at every asset, look at all the family dynamics, look at who it's going to, what their income tax rates, have all the professionals involved, especially the financial advisor. And then once you come to a plan, you have documents that support that plan, but that's not the actual plan. The actual plan is, everything combined, which is going to include beneficiary designations and things that don't go into the documents.
Totally. I want to go back to the ILIT side of things, because I think that is a really big misconception. And I think, Jacob, what you pointed out that was really important here is that, like, just a perfect example, right? Let's just say, 13 million is the estate exemption, to make it simple. If you have 12 million of assets and then you have $3 million of life insurance, yes, people are right by saying the life insurance isn't taxable, but it gets added to that wealth that you have. And if it puts you over the threshold, then you do pay estate taxes. And this is where ILITs come into play. So if we're thinking about this family situation we're talking about here, right? If you have estate taxes, maybe as they sell the business, they diversify, they own a ton of real estate. They're like, this is great to pass on. And they know, well, I'm going to owe $10 million of estate taxes. And the kids are like, well, we don't have a lot of liquidity. This is real estate and business ownership, et cetera. This is where ILITs come into play, is you can ensure that you have a life insurance policy to cover the estate taxes. There's obviously a lot more to it than that. You have to, figure things out, and gifting limits and all of those type of things, but super important. You have anything to add to that?
Oh, I was just going to say, sometimes when you're doing estate tax planning and the client's young, like, let's say they're in their 30s or 40s, sometimes that's the answer. It's not doing these irrevocable transfers, so early on, because there's so much time that's going to go by. They want access to the assets. We don't know where the law is going to go. It's pretty easy to create an ILIT and ideally purchase a policy from within the ILIT, so that you're not using any exemption and you don't have that 3-year rule. But it's the perfect way, especially for someone who's young, to have a resource to be able to pay that estate tax liability if it comes about, and not giving up control so early in life.
Totally. Last thing I want to talk about is trusts in different states, right? So a common thing that estate planning attorneys will bring up is, like, setting up trusts in 0% tax states. Let's talk about what the advantage of doing that is.
Sure. Yeah. I mean, there's a lot of states with zero income taxes and state income taxes, and there are a lot of states that have really strong asset protection laws. You think of Nevada, Alaska, New Hampshire, Delaware, and these are states that they have the strong asset protection laws because they're trying to attract businesses there. And that's why a lot of the trust companies are in these states. And so it can be a really strong tool for someone. Let's say they live in California and, they have a really high state income tax, to form a trust in a state with that has asset protection tools, like in Nevada, and be able to try to avoid state income taxes. Now, the issue with that, even though the thought is good, is that a lot of states are coming around to this, especially California.
Especially really only California so far.
Yeah. But you don't know if they're going to be following suit. But it's can be a really powerful tool. You just have to be really careful that if you're going to form a trust in another state, so let's say I own a big commercial real estate property in Massachusetts, and I say, okay, I want to avoid Massachusetts income taxes, so I'm going to put it in a trust in Nevada. The property is literally physically in Massachusetts. So you're going to have a hard time completely avoiding Massachusetts taxes and not having the Massachusetts Department of Revenue win that case that there's too much of a nexus to the state. So it can be a powerful planning tool to know where these asset protection states, where these low income trust states are. And if you can form the trust in that state and make sure that there's not too much of a nexus to your state of residency, then you can save a lot. You just have to be really careful, and you have to know that they're being heavily scrutinized.
And you have to be able to find a trustee in that state, which is going to come at a cost.
Absolutely.
Perfect. Anything else that you guys think that we need to add in as we have in this conversation we haven't talked about?
The only other thing, that I think comes up a lot, it's not necessarily a type of trust or a tool. It's thinking about, if you own a business and let's say you have a child that you want to inherit the business, you got to really think about equity. If you're looking to have the children, share equally in the estate, let's say, you got to really think about how that's going to work, because that's a pitfall that can commonly come up where, you want to leave assets 50-50, they get the business that's worth $30 million. Well, you don't have enough left over for the other child. So you really need to think of strategies for how you're going to deal with that. It could be that the child who inherits the business, maybe they owe a promissory note to the other beneficiary over a period of years. So you can do it in a way that doesn't really put them out. Maybe, they can get a loan to pay that other beneficiary. You can try and look at, life insurance or what other assets you could try and add on for that other beneficiary. But that's another thing that comes up is looking at what proportion of your estate is the business. And if you want to leave that to a child versus another child, how are you arranging for an equitable distribution?
Really good points. All right. Well, I feel like that's everything that we wanted to cover today. Obviously, this is some of the advanced things. I think the only thing we maybe didn't talk about is like QSBS, right? If this was a client and, this is a C Corp and it's QSBS eligible, you even have a longer timeline you need to be planning because, we have episodes earlier on this, but you can stack QSBS. So like you might, instead of only getting 10 million, you might be able to get 20, 30, 40, 50 million of capital gains exclusion minus state taxes in states like California. But other than that, I think we hit on everything really well. So Dave, we really appreciate you coming on and doing 2 episodes with us. I'm sure we'll bring you back on. If you guys love hearing Dave talk, we're doing it. We did a ton of episodes on the practical planner. That's more so, I think, for people who just want to learn about estate planning or advisors. And we know a lot listen, but everybody, again, we appreciate your time. Thank you for listening. Please rate and subscribe. And if you have any episodes you want us to do, please send us questions. I think Jacob and I are down the line maybe going to do more kind of like case study ones. If you send in your situation, we're not going to give you advice, but we could talk about things that we would think about based on the information that we have. So appreciate it, and we'll see everybody next week.